Every single software tool is becoming a bank. Your accounting software offers business loans, your benefits platform issues payment cards, and your e-commerce tool provides working capital. This is embedded finance, and it's reshaping the financial service industry. But here's a question. Why are companies embedding financial products? Well, the answer might surprise you. Toast and Shopify now make over 80% of the revenue from financial services and not their core software offering. And European companies like Dutch hotel platform Muse are following suit at 50%. And it's not only higher revenue, but also better retention and lower customer acquisition cost. I'm Lars Markel. I work as a fractional embedded finance expert and help non-financial brands to understand, design, and launch financial products. In addition, I run a weekly newsletter, bi-weekly podcast, host events, and I've seen both the massive wins and expensive failures in this space. In this video, I'll break down exactly what embedded finance is, show you the financial products you can embed, explain the 4 ways companies make money from it, help you decide how to build it, and most importantly, show you how to create that magical customer value that separates winners from losers. Let's dive in. Let's start with an obvious but also very important question. What really is embedded finance? If you think embedded finance describes any company that promotes a financial product, then you're wrong. In order to qualify for the embedded finance term, there are 3 requirements to be met. Firstly, it needs to be offered by a non-financial brand. Embedded finance is all about customer value. We'll talk about this later. But trust me for now when I say only a non-financial brand with a non-financial offering can create embedded finance magic. Revolut or N26 can offer great financial products, but they're not offering an embedded finance product. Only non-financial companies like Lego, DHL, or Total can be doing this. Secondly, it needs to be seamlessly integrated. Let me show you what I mean with an example. Co-branded credit cards, like your airlines or Amazon's credit card. You might think these are embedded finance, but they're actually not. Because there's no seamless integration, you often have 2 separate apps, 2 different logins, 2 totally different user experience. Often you have to leave one app, go to the other app, and come back. That's context switching, and that breaks the magic. With true embedded finance, everything happens in one place. Your points, your spendings, your rewards, all integrated into a single seamless experience where financial services feel like a natural part of the customer journey, not an add-on from a different company. Third, it creates new financial products, not just connects to existing ones. You're not just linking to someone's bank account, you're creating a new account, a new card, a new loan specifically for your customers. Open finance is a great tool in some ways, but often limits the opportunities for non-financial brands. To conclude, the best way to think about it, traditional finance forces your customers to come to the financial world. Embedded finance brings the financial world to your customer, exactly when and where they need it. But what financial products can be embedded? From my perspective, there are exactly 5 financial products you can embed, not more, not less. Let me break them down for you. And let's start with payments. Embedded payments is actually the hardest one to define, at least in my opinion. Because any business accepts payment in one way or another, so that cannot be the requirement for embedded payments. For me, embedded payment means you make money from accepting those payments. Shopify and Toast are the international role models, but let's take again Dutch Muse as an example. Muse offers a vertical software as a service solution for hotels. Whenever a hotel guest pays online or offline, it goes through the Muse platform, and Muse makes a bit of money. How? Simply put, the platform integrates a payment provider, agrees on a transaction fee, and charges their own customers a bit more. Second financial product, banking. Embedded banking means offering accounts and cards directly to your customers. This could be a full-fledged neobanking solution. For example, Laxware, a German bookkeeping company, or Agicap, a French cash flow management service provider, offer their own banking products. But it does not have to be a full-fledged banking product all the time. In some cases, it's just a card or just an account. For example, employee benefit providers like Ben from the UK or Swile from France, they offer cards so employees can access their benefits. Third product, lending. Embedded lending is probably the most powerful embedded finance products for platforms and marketplaces. Restaurant platforms like Volt and Just Eats offer loans to restaurant owners. Marketplaces like Amazon or eBay lend to merchants. And vertical software service providers offer financing to their business customers. Their key advantage? They have unique data that traditional banks don't. They know exactly how much revenue their customers generate, their payment history, their growth trends. This lets them offer a faster decision, better rates, and automatic repayments through future sales. Plus, they're solving a critical problem that's preventing their customers from growing their business with them. Fourth, investment. Embedded investment is the least developed area, in my opinion. Why? Putting an investment product into a non-financial customer journey is probably the biggest stretch among all financial products. That said, there are some really good use cases arising. For example, HR software providers that offer investment products to an employee joining a new company, or energy companies that offer investment product which allows customers to invest surplus funds and use them to reduce their future energy bill. Last but not least, and fifth, insurance. Insurance are part of the financial family, but it has the least connection to the other financial products. But embedded insurance is likely one of the most developed of the five. Many of these use cases are implemented at the point of purchase or rental. Think about an insurance for a new tech gadget, a protection for a holiday trip, or insurance for car rental. In one of my podcasts, I spoke to the pet retailer Fressnapf that offers pet insurances in their stores. They're making money from the insurance products, but from my perspective, even more important, they increase the touching points with their customers and opening the doors for additional sales. In my opinion, embedded finance is about these five financial products. If you're thinking, what about embedded crypto, payroll, or taxes? I would say some of them are subcategories. For example, crypto and payroll could fit under payments, and products like embedded taxes are not actual core financial products. They rather sit next to embedded finance and are not part of it. But hey, that doesn't mean they are not creating customer value. But how can you actually build an embedded finance product? To simplify it a lot, I would say you have three options: easy, medium, and hard. Think of it as a spectrum from buy everything to build everything yourself. The easy way means working with an all-in-one provider. If you want to offer banking, you find a banking as a service provider that handles everything: the accounts, the cards, the compliance, the regulation. One integration, one relationship, fastest time to market. And this is obviously perfect for testing whether your customers actually want embedded finance. But for money companies, it's likely also the only option they ever need. The medium way is mixing and matching specialized providers. To stay in the world of embedded banking, you might source your payment processor, your identification provider, and BIN sponsor separately. You will get more customization and potentially lower cost, but it's more complex and takes longer to build. The hard way is building everything yourself. Most importantly, getting your own license, hiring compliance teams, and building a lot of the infrastructure from scratch. You get complete control, but it requires massive investment in time, money, and regulatory expertise. My strong recommendation: if you don't know what the right path for you, it's likely the easy way. Most companies, especially those new to financial services, should begin with an all-in-one provider. Here's why. You can validate customer demand quickly, learn how financial services actually work, and you can always migrate to a more complex setup later once you have proven the concept and grown your expertise. Remember, your first embedded finance product will never be perfect. The goal is to get something good enough to market, learn from customers, and iterate from there. Don't let the complexity paralyze you. Start simple and evolve as you grow. Now, let's talk about money, because that's probably why you're considering embedded finance in the first place. There are four ways companies can make money from embedding financial products. First, direct charging. This is the most obvious one. You simply charge a fee for your financial product. Maybe it's a monthly fee for a business account or a transaction fee for payments. It's straightforward, but be careful. Especially consumers often expect financial services to be cheap or free, so this alone rarely drives the biggest returns. Second, kickbacks. Instead of charging customers directly, you earn money from the financial transactions themselves. The best example is interchange revenue from card payments. Every time someone uses a card, the merchant pays a fee, and the card issuer gets a portion of that fee. In some markets and products, these kickbacks can be a meaningful revenue stream. Third, data insights. This one is more subtle, but incredibly valuable. When you offer financial products, you gain deep insights into your customers' spending patterns and financial behavior. For example, a retailer offering their own card can see exactly where customers shop with competitors, how much they spend, and when. These insights let you optimize pricing, promotions, and product offerings across your entire business. Fourth, and most important, increased usage of your core product. This is where the real magic happens. The best embedded finance companies create a flywheel effect. Take marketplace lending as an example. When you offer loans to your sellers, they can buy more inventory, which means more sales on your platform, which means more revenue for you from transaction fees and commissions. The financial product doesn't just make money directly, it supercharges your entire business. And here's the key insight. The most successful embedded finance companies don't just add a financial product on the side. They use financial services to solve their customers' biggest problems, which then drives massive growth in their core business. That's where the real money is. But here's what I've learned from advising dozens of companies. Knowing these revenue models isn't enough. Most companies that attempt embedded finance fail to capture these benefits. So what separates winners from losers? So here's a secret that separates successful companies from those that fail. You need to create what I call magical customer value. Let me explain this with a simple equation. 1 + 1 = 3. When you take a non-financial product, let's say it has a customer value of 1, and you add a financial product with a customer value of 1, the result should have a customer value of 3. The whole needs to be greater than the sum of its parts. Here's what this means in practice. The best embedded finance products aren't just a financial service sitting next to your main product. They're completely integrated to create something that didn't exist before. Your customer should look at your embedded finance offering and think, this is a no-brainer. I can't get this anywhere else. Take marketplace lending. Your sellers have cash flow problems that limit their growth. Banks offer generic loans, but you can offer loans based on their sales data from your platform with automatic repayment from future sales. That's not just convenient, it's a fundamentally different and better product that only you can offer. But here's where many companies go wrong. They build embedded finance products simply because they can. Maybe they think their brand is so strong that customers will automatically choose their financial services, but that's not how it works. Your customers have dozens of options for financial services. What matters is solving their real problems in ways that others simply cannot. The companies that win start with the customer's biggest pain points. They ask themselves, what financial friction is preventing our customers from succeeding? And then they build products that eliminate that friction entirely, creating value that's impossible to replicate elsewhere. Remember, if your embedded finance product could just as easily come from a bank or a fintech company, you're probably not creating magical customer value. But if you solve problems that only you can solve, that's where the magic happens. We have covered what embedded finance really is, the 5 financial products you can embed, how to build them, how to make money from them, and most importantly, how to create that magical customer value that makes you win. Here's my key takeaway for you. Embedded finance isn't just a nice to have anymore. It's becoming essential for European companies that want to stay competitive. But success isn't guaranteed. It requires starting with your customers' real problems and building solutions that only you can offer. And if you're thinking, this sounds interesting, but I need to learn more, you're in the right place. Check the description for a link to receive my free slide deck, How to Win in Embedded Finance. Simply enter your email address, completely free. And if you're serious about exploring embedded finance at your company, I would love to chat. I help non-financial brands to navigate this space, from initial strategy to provider selection to execution. Every company situation is different, and sometimes a conversation can save you months of research. Thank you for watching. I'll see you in the next video where we dive even deeper into the world of embedded finance.